So you got 10K and you want to invest it, what are you going to do? Well, here are the 5 investments I personally make if I started all over again. Starting with putting around 20% of that money in an index fund that tracks the S&P 500, which represents the 500 largest companies in the US. And there are a bunch of mutual funds and ETFs that track the S&P 500, such as SPY, VOO, SPLG, and FXAIX. Now, for example, VOO is a Vanguard ETF that tracks the S&P 500 and is one of the most popular ETFs that Vanguard themselves offer. But if you want a mutual fund version instead, VOO's mutual fund counterpart is VFIAX. But regardless of which one you pick, the single most important thing is what's on the inside. That's what really matters, right? But essentially, they're all practically the same thing, which is great because if they're tracking the same index, then they're gonna grow at the same rate and they're gonna provide the same exact amount of returns. Now, speaking of what's on the inside, for example, VOO again, that is just essentially tracking the S&P 500, which is weighted by market cap. So the top 10 holdings, if we look into this fund, covers companies like Apple, Nvidia, Microsoft, Amazon, Google, Meta, and it kind of just goes down the list from there. Another thing you should focus on is exactly knowing how much you will be charged to hold onto the fund, aka the expense ratio. Now, this expense ratio or this fee you're going to be charged, it's not like you're going to get a bill at the end of the year for it. This amount is just automatically taken out at the end of every year. So for VOO, the expense ratio is pretty low at 0.03%, which means that you will pay only about $3 every year for every $10,000 invested, which isn't bad. Now, the main reason I like having the S&P 500 index or something that tracks the index in my portfolio is because of 2 things. One, it is stable, and number 2, it is a stable, steady grower, right? There's nothing crazy, there's nothing to scoff at either. I see it like having the foundation to a garden. Now it's time to throw in a little bit of pizzazz, a little bit of fertilizer, just to speed it up a little bit. Which brings up the second thing that I would invest in, and this one's a little bit more risky and volatile, and it's more specifically something that tracks the NASDAQ 100. Now, personally for me, I'm almost 30, but I still consider myself pretty young. I'm okay taking on more risk, which is why I'd like to invest about 50 to 70% of my 10K over here. But if you are closer to retirement, if you have a family that relies on you financially, or if you have a lower risk tolerance, then you might want to prioritize the 4th investment that I'm going to go into a bit later. The NASDAQ 100 is basically the top 100 tech companies in the US, and some index funds that track this are QQQ, QQQM, FTQI, and 1Q. Now let's just take QQQ as an example, which stands for the Invesco QQQ Trust Series 1. And this includes tech giants like Apple, Tesla, Nvidia, and Alphabet/Google. Now, one of the most common questions I get asked at really fun parties is, hey Vincent, the NASDAQ has a lot of overlapping stocks with the S&P 500. Like you just named 4 stocks that are also included in both indexes. What do you have to say about that? Well, all I have to say is this. You are 100% right. It is true that the NASDAQ 100 and S&P 500, there is a lot of overlap. But the QQQ is a lot more concentrated. For example, in the past 10 years, QQQ has returned about 400% compared to VOO, which has returned about 200%, which means that even though it does have these overlaps and these overlapping stocks, their holdings with each other are different enough to yield such a drastically different return over the long term. But it's really important to remember, with great returns come great risk, right? It's a double-edged sword. For example, in 2022, while the S&P 500 dropped about 19%, the NASDAQ dropped around 33%. It's also worth noting that the expense ratio is higher than VOO. Right now it's at 0.20%, which means that you're gonna be paying $20 annually for every $10,000 invested. And the main reason that I like having the NASDAQ 100 in my portfolio is because I see it as more of a wealth accelerator. All right, so now our plants are growing, right? We got some organic fertilizer there. Now let's get a little wet and wild. The third thing I would invest in is crypto. And I know what you're thinking, but hear me out before you pop a blood vessel. I've been investing in crypto since 2011, and transparently, I made a lot of money from it. But I will say that it's not for everyone. I mean, even for me, crypto is still only a very small percentage of my overall portfolio, around 10%-ish. And the reason my allocation is so small is because crypto is one of the most volatile investments out there. And just take Bitcoin, for example. It went live or it launched in 2009, but the price of Bitcoin stayed under $1,000 until 2017. At which point it exploded to like 20K in December. And then there was a drop for a couple of years when crypto was crashing left and right all over. But after that, it's been hitting all new highs, up to over 100K in 2024. Now, one thing that people always ask me is, how do you safely invest in crypto? Now, I personally use Coinbase, which is the leading cryptocurrency exchange in the US. Millions of people use it to buy, sell, and manage their crypto every day. And also it's a publicly listed company on the stock exchange. So it's basically the industry golden standard. I've been using Coinbase for so long that they actually agreed to sponsor this part of the video and give you all some Bitcoin for free, but more details on that in a second. If you've never invested in crypto before, it can seem very confusing. But thankfully, Coinbase is one of the most user-friendly platforms that I've ever used. They have both an app and a website. They're both really clean and easy to use. Plus, they have a bunch of different coins that you can choose from, including Bitcoin and Ethereum. Now, one of my favorite things about Coinbase is that they have this thing called Learn and Earn program, where you can take free lessons to learn about crypto, and then you get awarded with free crypto. Plus, most lessons only take about 2 to 3 minutes to get through, so it's pretty short. So if you're interested, I actually got Coinbase to give everyone $20 in Bitcoin for free when you sign up and make your first trade through my link below. Clicking that link supports the channel, but more importantly, gets you $20 in Bitcoin right off the bat. So what crypto should you invest in, right? All cryptocurrencies can essentially be broken down into 3 types of risk categories. One, there's low risk. These are kind of like the major crypto brands or coins that are already well established in the space and are the most popular ones, which include Bitcoin and Ethereum. Number 2, there's medium risk, right? These would be the cryptos that have some sort of product application and are reasonably established. And these are things like Ripple. And then there's number 3, the high risk, right? This is anything that's been created in the last few months or a couple of years. These are meme coins, right? Most crypto are belonging in this category, and most of them will be essentially worthless in a couple of years. Now, I personally invest in primarily low risk and occasionally dabble in medium risk cryptocurrencies. And the main 2 reasons I like to have crypto in my portfolio is number 1, if NASDAQ was the fertilizer, crypto is literally taking a seed and injecting it with actual steroids. For example, since 2011, the all-time growth of Bitcoin is more than 20 million %. And for comparison, the NASDAQ's cumulative growth in that time period is about 541%, right? Even looking at average annual returns, Bitcoin's rate of return stands at around 230%, which is 10 times higher than the NASDAQ 100 index. The second reason is diversification. Now, according to BlackRock, Bitcoin looks like a potential way to diversify away from traditional stocks and equities. Meaning, BlackRock expects when the stock market falls, Bitcoin may not necessarily follow the same pattern, which could help reduce your risk of inside your portfolio. All right, so now our plants are growing, right? They're full of fertilizer and some steroids. Now it's time to balance it out a bit. The fourth thing I would invest in is something that tracks large dividend paying companies. And the reason for this is that large dividend paying companies are pretty stable, meaning the stock price of them won't go up or down drastically. They're generally the safer option, the choice when the overall market starts to go down. Meaning if you want more stability and you don't like taking risk, then this is a great fit for you. The second benefit here is that with dividend paying companies, you get paid dividends, aka passive income on a monthly or quarterly basis. At my age and my risk tolerance, I am personally allocating less than 10 to 20% of my money here because my focus right now is to prioritize growth over passive income. But if I were closer to retirement or if my investment strategy shifted and I needed more cash flow, then I would allocate more into this pile. Now, some index funds that track dividend paying companies include SCHD, VIG, VYM, and SDY. And we're going to take SCHD as an example, which stands for the Schwab US Dividend Equity ETF. It includes solid names like Coca-Cola, Pfizer, and Verizon. Now, SCHD's expense ratio is pretty low, which is 0.06%, which means that you're going to pay $6 annually for every $10,000 invested. And over the past year, SCHD returned about 11%. And then in the past 3 years, it returned about 4%. Now, First, hands down, 11% is very impressive, especially for a dividend-focused ETF. But transparently, I will say the 4% return is nothing to hit home about. But remember, the goal of these dividend ETFs is that it's really passive income and stability and not necessarily growth in itself. So if it is growing fast, then that's an extra plus. SCHD pays a quarterly dividend, and the current yield ranges between 3.5 to 4%, which fluctuates depending on the market. But let's just say it's 3.5% to be more conservative, right? Meaning if you invested 10K here, you'd receive about $350 a year in dividend payments. Now, the main reason I think it's helpful to include dividend-paying companies or ETFs in my portfolio is for that additional stream of passive income, which can be a really good cushion if the bulk of your money is tied up in your investments, like your other stocks or your crypto that you can't touch or access. You don't really want to be in a situation where you're asset rich, but you are cash poor and you can't afford anything like paying off the bills or anything like that. Having dividend-paying companies keep your cash flowing. Which brings us to number 5. All right, so the fifth thing I'd invest in, for you to really understand what it is I need you to think about what you need to do to get to your next big financial milestone, right? What is it long term? Right now, you have 10K. The question is, how will you get to 100K, right? Because that is the ultimate goal, to continue moving up, to continue building wealth. Now, contrary to what most people think, getting to 100K isn't really coming from investing, right? Now, that's not to say that investing your money in stocks and crypto is a bad move. It's not. It's crucial to build out your foundation. But what is more important to get to your first 100K is your income and your savings. And to prove that point, here's an example. If you save $12,000 a year for 7 years and get a 5% return, you'll reach $100,000 in 7 years. Now, that's great, but 84% or $84,000 of that $100,000 came from your savings, while only 16% or $16,000 came from investment returns. Now, on the other hand, if you save less at, let's just say $7,000 a year, but you get an 11% return, right? A bit more than double from the first scenario, it'll still take you 9 years, 2 additional years to reach $100,000. And even then, 63% or 63,000 of it came from savings, and the other 37% came from investment returns. So the point is, getting to your 100K milestone is more about increasing your income and increasing your savings rate and less about investment returns. Now, once you have your first 100K, it starts to switch around, where it's more about your investment returns and less about your income and savings. So basically, the fifth investment I'd make is investing in myself through education and upskilling. Now, more specifically, upskilling in the sense of increasing the chance of getting a raise or increasing different income streams to ultimately increase my income. And I focus on financial literacy so I can learn and know how to optimize my money. And this kind of brings me to something that you've got to start understanding. And it's that even if you've been trying everything you can to build wealth and to get rich, right? Sometimes it can still feel like you're not doing enough. And that might be because you don't know the 3-part formula they can start doing today on how you can go from 0 to 100K. So click here to learn how you can actually get to 100K in 2025.